Deccan Cement is a small-sized cement manufacturer with an impressive track record of consistent performance. In fact, the firm has produced solid operating metrics stemming from strong financial performance amid competitive market conditions. Investors should keep a close watch on the stock as recent quarter results reflect strong recovery from COVID-led disruption. Deccan Cement's top line during Q2 came in largely unchanged at 191 crores as volumes and realizations dipped by 2% and 1% respectively. The company reported an EBITDA margin of 20.4% during Q2 FY22 compared to 25.3% in Q2 FY21, which is a contraction of almost 480 basis points on a year-on-year basis. Although pan-India cement demand has staged a solid comeback post the second wave, the offtake across southern markets was muted due to adverse weather conditions. Government's infrastructure push along with revival in construction activity supported the overall demand environment, but on the flip side, you had heavy and persistent rains across Andhra Pradesh and Telangana, which is Deccan's key operating market, which led to a minor fall in cement volumes. Besides, the realizations also slackened due to soft demand conditions. Margins declined on a sequential and yearly basis due to steep inflation in input costs. All the major cost overheads, fly ash, power and fuel, freight, packaging, so on and so forth, have risen sharply due to unprecedented increase in commodity prices. While crude oil has moved from $40 to $80 in the past 1 year, the price of pet coke has more than doubled in the same period. As a result, Deccan's profitability metrics came under pressure despite stringent cost control measures. It reported an EBITDA per ton of 886 rupees during Q2, which is a decline of 20% on a year-on-year basis. Deccan has very strict cost focus and has been undertaking small-scale capex projects to rationalize its cost structure. The company has already set up wind and hydel power plants to meet its energy requirements. In December 2020, Deccan commissioned a new 6-megawatt waste heat recovery system to save costs further. Management has maintained strong financial discipline throughout its history and has been using internal accruals to strengthen the balance sheet. The company currently has a clinker capacity of 1.7 million tons along with grinding unit of 2.2 million tons. Over the next 2-3 years, the company aims to double the cement capacity from current levels. The expansion plan has been approved by the board already and the company has also obtained environmental clearances for the same. The cost of the project, the total cost is estimated to be around 600 crores and the funding will be met through a combination of debt and internal accruals. The completion of the project will take about 18 to 24 months and the new plant is expected to come on stream by FY24. In October-November, cement companies undertook multiple price hikes to pass on the steep jump in input costs. Majority of industry participants, whether it's manufacturers or dealers, both were anticipating a pickup in demand post-Diwali. But on the contrary, unseasonal rains and inflationary market conditions have upset the demand momentum in November and December, and cement price hikes have been rolled back partially due to weak demand as well as volume pressure. Elevated energy and freight costs will weigh in on the margins in Q3 and Q4 as well, as the net absorption of prices has been just about 10 to 15 rupees per bag. The company is well positioned to benefit from favorable demand patterns arising from infrastructure spending and recovery in sectors like construction and real estate. Over the medium to long term, we expect Deccan Cements to generate significant value for its shareholders, resulting from factors like economies of scale, consolidation of the market, and favorable industry dynamics. Now, if you go back a few months, in April 2021, we had recommended the stock at around 410 levels as part of our Discovery series. Now, between April and August, the stock nearly doubled from those levels. And the recent weeks, if you see, the stock has retraced 30% from the 52-week highs and is once again trading at attractive valuations, which is FY22 EV to EBITDA of about 5x. Also, with respect to its peers, it looks fairly valued. Even on an absolute basis, the stock is being valued at an EV per ton of $60 only, which again appears at a deep discount to the usual replacement cost of $100 per ton. Risks to watch out for. Well, while demand appears to be on the mend, reinstatement of lockdowns and inability to pass on input costs could result in subdued performance over the short term.